When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. How you feeling after that Super Bowl, my friend?
Oh, man, it's like kind of gassed a little bit, actually.
I know.
I think Brock Purdy stepped up, did a great job, and if it wasn't for a kicker missing an extra point, maybe he was paid off. I don't know. I hate to say that, but, just that one extra point missed, made the Chiefs play a different game. All they had to do was get a field goal to stay in it, and that's what they did, rather than have to go for the touchdown. If they were forced to go for a touchdown because there was a 4-point deficit, that could have changed everything. But Kelsey didn't do anything till that last game except try to punch out his coach. I don't know. I think the organization needs to rethink that. I think he needs to be fined big time.
Hey, Super Bowl is behind us now. We've got March Madness to look forward to. NBA season still going on. And, of course, in Arizona, up in Phoenix area, spring training has begun, so there's a lot to look forward to in sports. But as I've said many times in the program, we're not here to talk about sports. We're here to talk about finances and your journey towards a successful retirement. So, Jeff, this past Tuesday, I understand the CPI results came in, and they were slightly different than what we expected. Can you elaborate on that?
Yeah, the Fed is really just a pawn. They were put into play, 1932 or the 30s, sometime right after the Great Depression, I believe, in order to manipulate Wall Street and kind of be the right financial arm of the government so that they could manipulate and control stuff. And boy, this is about as good as it gets. We know that all that extra QE money eventually had to cause inflation. Every economist, everybody who'd been to business school knows that. But nobody wanted to believe it, and they just kept using it to pump up the market, and everything was hunky-dory. They loved it. The Fed's a hero because they kept interest rates down. Stupidly low. And then all of a sudden, it came time to pay the piper. It came time to, the chickens came home to roost a little bit, and it's like, inflation's out of control. So what do? You raise interest rates. And as long as interest rates are going up, that's bad for tech, decent for banks, other than the fact that the pandemic made people work at home, and so commercial real estate suffering really bad, and banks couldn't keep up with the high deposits and CDs and things like that. So we had a regional bank failure last year. And although the government did not lower rates at that particular time, in fact, they kept raising them, they did bail the banks out to the tune of, from what I'm hearing, and again, this is, I don't have the inside insight. Most people, smart people, billionaires that I listen to that are, economists and hedge fund managers say it was to the tune of $4 trillion plus in QE money that went to banks, not to, us. In fact, all the excess savings that they had piled up in business accounts and personal savings accounts that had kind of propped up the market for the last few years disappeared last September, yet somehow the market continues to go up. And then, of course, the manipulated Fed, the puppet of Wall Street and the regime in the White House, says, hey, you know what? Let's just give them some fake hope and say inflation's coming under control, and we're not going to raise interest rates anymore. Just say that. And let's get another push, because the banks still have a lot of money they want to buy NVIDIA and Microsoft and some of these big tech companies with, which is what they've done, really just manipulated the indexes up by 6 or 7 stocks. But it's been really the market makers, and the banks, by the way, own the big brokerage firms. Merrill Lynch's Bank of America, Morgan Stanley, Goldman Sachs. You got JP Morgan is Chase, right? JP Morgan. So they all basically are market makers. They are the banks. And somehow, even though they have record defaults on mortgages and have to buy up, CD interest at 5%, they're using the Fed funds money even at 5% to invest in the stock market. The repo account, which is typically supplies Fed funds money, I heard was down to somewhere in the neighborhood of $800 or $900 billion instead of 2.4 or 2.5 trillion where it normally is. So what are the banks doing with all this money? I think they're trading their own stock. They're doing their own stock buybacks. They're trading in the market, and they're manipulating the market up. And that's happening when, Facebook comes in with earnings it gaps up $60 or 20% in a day. That stuff doesn't happen with normal buying. That's not normal buying pressure where you get a whole bunch of buyers saying, oh my gosh, we should buy more. And you see that orderly growth on that stock. You see NVIDIA jumping $20 at a time, up and down and all over the place. Wild gap moves in the market, which are really market maker driven, in other words, bank driven. In other words, manipulation. And I haven't seen this since the .com bust, which was kind of the first real experience I had with a bear market or with a sell-off or with a manipulated market that was manipulated to just horrific proportions. In fact, there's economists today that say that it's even worse than then. And I'm seeing the same things happen where it's just, there's a disconnect. It all happens because the Fed says, hey, inflation's under control. It's just going to immaculately drop, just, miraculously just happen to be 2% by next year. So we're not going to have any more rate increases. And the market goes up like crazy. And he even doubles down. And I'm sure he's got to be getting something for this. I mean, Wall Street's got to be buying him houses in Tahiti or something. I don't know. The guy's got to be getting something for this. For a guy that makes less than $200,000 in a salary to be this big of a shill for Wall Street and even the political party that is now in control. I hope he's getting something for it because he's totally lying to the public. And that was a ball-faced lie. Now, we've kind of been able to believe Powell for a while because he says, hey, inflation is not under control. We need to raise interest rates. It's still not under control. We're going to keep raising interest rates. That's always bad news. But the Wall Street keeps saying, no, he's really going to lower them. No. We've got earnings. Earnings are going to grow. So it's okay to overpay for stock. And he goes, well, we're going to raise interest rates. And so last year, Wall Street and the news talks everybody into buying stocks up 30% when there was, on average, for the S&P 500, less than 1% earnings. That doesn't make any sense. But it was bid up. And it's like, okay, so we're going to come into earnings season, at the end of the year. And now we're doing it right now for the final quarter of last year. And we're finding some companies beat earnings, some companies didn't do so well. Overall, I think it's pretty lackluster results, but it's certainly not 30% earnings growth, which would reflect the stock market rebound. So then in December, Fed chair goes, hey, we're going to lower interest rates 3 times next year. And inflation's still at 3+% or 4%. What? Oh, but it's going to come down. We don't want to overstep and overreach, which they normally do. And I get that. And honestly, I believed it because why? The last year, what he's been telling us, he's been doing. And then all of a sudden now what he's telling us seems like, wait, that's unjustified. The rest of the FOMC, the Federal Open Market Committee, which are the Fed chairs for the different districts in the country, are all saying, wait a minute, we never talked about reducing interest rates. We never talked about, lowering the Fed rate. That's weird. Oh, well, we haven't had that discussion in the meeting, but, Chairman Powell's a spokesman for our group and, that's what he says. Okay. And then you get the banks that come in and say, oh, he said we're lowering them 3. We expect 7 rate decreases. I don't know what happened. Mindless or brainless investors. And I think a lot of them are young, chief investment officers or banks that don't really know fundamentals. They never really learned that. Maybe they learned it in college, but they've never had to deal with it because it's all been based on QE and the fake money game that the government's learned to create since the '08 crash. And that is, hey, print money, the market goes up. Just keep printing money, the market goes up. Keep printing money, the market goes up. Well, you can get on that ride, but if you keep printing money and the market goes up and those companies are using that money and lower interest to actually increase earnings, that made sense. Even though I think overall, if you look at history, the last decade has been a little bit overvalued in the stock market, but the growth in the earnings was there. It hasn't been there. And now the Fed is lying to us saying, oh, inflation's under control. We're going to lower interest rates 3 times. And then the banks say, oh, no, it's going to be 5 or 6 or 7. And all the people that go, okay, whatever, because they believe everything they hear, they just keep on playing the dangerous game. Until when? Until they get slaughtered. Every bubble has to pop, and this is the biggest bubble we've ever been in, biggest bubble I've ever seen. If you look back in charts, you can see the bubble that burst in 2000 and 2002. You can see the bubble that burst in 2008. You can see this bubble growing and growing and growing. Every time it tries to pop, they just inject a whole bunch of capital in it, make stocks go crazy again. So we can either get on that boat and say, well, the government's going to always save our butts. Let's just go in the market and keep riding this train, or we can see what's happening right now. And the fact is, the last few, Fed meetings, well, the last ones at the end of the year were BS. And he kind of took a step backwards a couple weeks ago when he said, oh, well, we may not have to lower them quite so early. Don't expect one in March because, well, inflation's still kind of high. We're expecting it to come in, kind of in the 2.9 range. Turns out now we've got this 3.1 year over year rate. It actually 0.2 of a point higher than expected. And 2.9 is not a number that they feel comfortable with. They want it around 2. The other thing is even worse, the core inflation, which takes into account the things without gas and food, which I think is still a manipulated number. Obviously, a carton of ice cream, for example, is smaller, even though it costs the same. So I guess if you use the same carton price rather than the amount you get, the inflation isn't going up. And, Biden was pretty upset about that last week during the Super Bowl. But anyway, we'll talk about about that maybe a little bit, about Bidenomics not being shrinkonomics. He is the cause of all that. So the core inflation comes out 3.9. That's almost 4. That's about double where they want it to be. How in the world can you have rate decreases when that's happened? Yet we've already priced in 30% growth in earnings. We haven't had that. We haven't had anybody have 30% growth in earnings, maybe 5 or 10. And that's from a lower revised number. We have the leading economic indicator index down for 20 straight months. We have inflation continuing to grow 4% a year on top of the 20 or 30% that we already have. Everybody's already paying 20, 30% more. Now you've got to pay 4% more than that. You know, if you look at 4% on top of, let's say, 120% of what we were spending money on 2 years ago, that's really about a 4.8, almost a 5% rate of return, because you've got to add the 4% to the 20% growth in increases in prices that we've already experienced. So it's compounding inflation, and nobody's taken that in consideration. It's got to get down around 2% in order to be close to that range that they need to for the economy to clip along to where the government doesn't have to keep on creating jobs to fake the numbers out. The government doesn't have to keep on creating GDP. 60% of the 3.3 they got last GDP report, I believe, was attributed to government spending. That's not a healthy economy. And just the service on the debt's going to outpace that 3.3% growth. So there is a lot of things that are totally out of whack. Inflation's still out of control. The lies about decreasing the interest rates are lies. They're just flat out BS. They can't do it. And if they do it, it's just manipulation, quantitative easing, and it's injecting money into the economy, which is, I think, financial abuse. It's malpractice in its biggest degree, which I think has been the case all along. When the government prints money, it's pretty much financial malpractice. But they have the Fed on their side to give us a narrative or a story of why it's necessary or what's going to happen. Wall Street loves inflation. That's how they make money. The more things cost, the more profits, the more they make money. So they don't mind inflation. They don't mind all this extra money. But there's going to come a time when the bubble has to pop and it has to reset. And guess what? They're going to be the ones that made the most money along the way. And they're going to be the ones that get out first. They're going to keep making the money. And people that can't afford to lose money are the ones that are going to be left holding the bag. Now, again, I've said this in the past. I focus this radio show and most of my practice on people that want to protect their assets and not take too much risk, want to protect their life's work, right? You've already done this, investing in the high crazy stocks. And if in the last decade you made a ton of money, take some of that off the table, because pretty soon the banks are going to do the same. You want to be out first. You want to be out before them. So be careful going into this market. This is not just hey, the momentum's up, let's just jump on the train. That train might be ready to hit a big brick wall if that bubble pops. And I think there's a lot of political reasons that I'm looking at that just point to the fact that there might be some catalyst to make that happen in the near future. The biggest thing is the inflation, which I believe has been kind of a manipulated number and kind of reported as however they want to report, was reported high, which means it's probably higher than it is, because I think they're kind of fudging the reports or twisting the numbers enough to make everybody happy and think everything's okay, especially in an election year. So I think we're probably in a little bit worse shape than people thought, and this is not healthy for the market. So this might be the catalyst that ends in sell-off. I mean, early this week it started. It's kind of been, the market's so far up. I don't know how long it's going to take to have a big major sell-off. We're due for a correction anyway, just from the craziness and all the fibbing that's gone on since November. I think all those gains since November are really fake manipulated gains. There is nothing fundamentally that makes a lot of sense, other than Facebook and Amazon had a little bit better earnings than expected. But again, they finally got to where they were fairly valued, and now they're way overvalued again. They weren't even fairly valued. They were just not so overvalued. Again, you can buy stocks that are overvalued, and if everybody keeps buying them, that's fine. But there'll come a time when people just are tired, they're out of gas, and they can't do it. And right now we're seeing a lot more selling coming into the market than buying. Who knows? We might be at that top range where we see an extended sell-off. We'll have to see what happens in the next few weeks or few months. It's not uncommon that the first half of the year before an election, we have kind of a soft to a down market. And then once we know who the nominees are going to be and the election's coming around, we kind of want to wait, see what happens, and nobody really wants to make any judgment on the market. So there's not typically a huge sell-off around the election time. There's typically kind of a leveling off or even an upswing in the market from what might have been down the first part of the year. And then going in after the election, typically we have a little bit more stability.
We're talking with Jeff Olgan of Premier Retirement Planning and Wealth Management here in Tucson and also Mesa. We're talking about the current state of the economy and the recent CPI report that came out earlier this week. If you like what Jeff is talking about here and you're impressed with his knowledge of the market and the economy, you want to see how he puts that to work for you in creating a retirement roadmap, we invite you to call this number to get your no-cost, no-obligation retirement roadmap, a chance for you to sit down with Jeff and ask your questions. That That number to call, 520-780-9059. Now, you can call it this weekend if you want. You can call it right now. Simply leave your name, your telephone number. Shelley will give you a call back next business day, take down some basic information, and set you up with an appointment with Jeff to talk about your concerns about the market and the economy and your journey towards retirement. Once again, that telephone number, 520-780-9059. No cost, no obligation for this 5-point retirement review that includes an income plan, investments to support the income plan, tax plan, health care plan, and also an estate plan. All that, and it doesn't cost you a dime. 520-780-9059. You can also request your plan online at premret.com. That's PREMRET.com. Jeff, earlier you talked about the market looking similar to periods in the past in which the bubble has burst. David Rosenberg is the president of Rosenberg Research, and he says that the stock market looks similar to periods that preceded the dot-com and 2008 market events. He goes on to say that the speculative mania carrying the stock market could end very soon. In other words, he's looking for that bubble to burst as well.
Well, I mean, I'm not the only one who thinks that. I mean, here's the thing. I've said this on the show for months, and that is, I prefer to do the things the billionaires are doing, the people that have made money and are protecting, huge amounts of money, and see the market on a very, I guess, macro basis, not just, oh, look at the market's going up today. Let's jump on the train and let's hope we make a few bucks. I mean, that's kind of a day trading mentality, which, by the way, is kind of how things have gotten in the last decade because of, every time the market is infused with money from QE, people just start speculating, oh, the momentum's up. I got a good chance I can day trade and, pick the right stocks and we'll do okay. And, honestly, they've done okay. There's people that manage funds, people like, John Bogle, who, has died a few years ago, but, was important to listen to. Templeton, a long time ago before that, had Templeton funds. I mean, the people, these big fund managers, they're people that know stuff, right? Well, going back to John Bogle, Jack Bogle, he's Vanguard owner, and right before he passed away, coming into the decade of the 2020s, he said expect 2 crashes of at least 50% over the next decade. Shortly thereafter, Warren Buffett says, hey, this is a bubble and it's going to pop. He says, I'm a buy and hold guy, but just expect the market to retract by about 50% not in the not too distant future. And then we had COVID and a whole bunch of money infused, and that kind of kicked that can down the road. But pretty soon there's not going to be any more cans to kick. Let's go back to Buffett. What has he done over the last year? He has liquidated over $200 billion worth of stock and has cash. Why would he have cash when the market's going to the moon? Why would he have cash when he could have made 10 or 20% just investing in the S&P 500 index? Because he knows those same banks that are rallying the stock market by buying, and gapping the market up $60 on Facebook or whatever it was some stupid number with a gap. There's nobody bought between the close of yesterday to a new close of $60 higher on the open. That means a market maker, the powers that be, just go, oh, let's just throw a number out and see how many suckers we can get jumping on that game. Warren Buffett knows that those same banks can dump the market $20 or $50 or $70 a share on a $400 stock the same way that they could raise it. Now, we saw when the numbers came out, I think last Tuesday on the CPI, that the market, opened up down right away. I know the Dow, kept going down for quite a while. The NASDAQ opened, everything opened down, but it didn't really gap down that much. It gapped down, then it kept kind of trickling down, and then we've had, the market that we've seen since then. But we've got, weakness that can show up at any time with a CPI report, but there's still so many people that are ready to jump on that train because the momentum or the direction is still up that nobody believes it can go down. But when the market makers want it to go down, it's going to be a race to be the first one out. Anyway, Lacey Hunt is Executive Vice President, Chief Economist of Hoisington Investment Management Company. But Lacey Hunt is an economist that has some really important things. They've been around a long time and says, are we clear? Do we see a soft landing? Can we sidestep this? What's going on? And the interview goes around. I'm going to try to find the final status of it. It says, based on dozens of measures that include valuations, internals, overextension syndromes, and numerous technical, fundamental, and cyclical gauges that we've developed over time, we estimate that current market conditions now cluster among the worst 0.1% instances in history. 0.1% instances. That's way beyond the bell curve of probability line that ends, somewhere in the 98% range. So, this is like 1/20th of the out of statistical probability. It's horrible. 0.1% instances in history, more similar to the major market peaks and dissimilar to major market lows than 99% of all post-war periods. He calls this the cluster of woe because the handful of similarly extreme circumstances, most notably, and look at these up on the charts, 1972, 1987, 98, which was just a slight correction. And then they got back on the train, kind of like we did with a slight correction, I think, in 2022, which was a slight correction, kind of like 1998 was, before the market rallied to 2000 and then had the big crash. We've just seen that. We had the same thing as in 1998 where we had a retracement of stock prices, and then people says, forget it, we can still do this. And, I think it was Alan Greenspan at the time was Fed chair, if I'm not mistaken, and talked about the over exuberant market, and he did some finagling with the interest rates, and then pretty soon the market just shrugged that off and went full bore ahead till 2000 before it crashed. So I think that's kind of what we're seeing right now is we're seeing, this crash in 2022. Nobody wants to believe it. The markets are being manipulated by a little bit of Fed money going to the bank so they can buy stocks and keep propping them up. We're seeing banks have profits, but we know they're not lending money, so it must be all trading. That's all I can surmise from all that. Then we had the 2018. That was about a 25% correction. We had 2020, which was 30%, but it came right back because they infused a ton of capital after COVID, the COVID scare. And then the 2022 was a bad year. So basically, this cluster of woe, because a handful of similarly extreme circumstances are talking about these different corrections, were typically followed by abrupt market losses of 10 to 30% over 6 to 10 weeks. The average down was about 12.5%. I think because of how stretched this bubble is, we're probably going to err on the side of maybe the 30% type correction, which gets us kind of back below where we were, before the market started rebounding at the end of 2022. So the loss at the smaller end of that range, seeing a deeper follow through later. So we might see a little correction, try to see a rebound, and then deeper follow through later. These are people that have seen these things over and over again. People have been in the market for decades, not just finally got rich the first time in their lives over the last decade, which I think most investors and most private households that own stock really have not made any money until recently because income has been high enough that they could load up 401ks, they could invest all the stimulus money in the market, they could do things that makes them think that there is no end to the upside in the market. Yet these old timers, Warren Buffett, Lacey Hunt, Hussman, got John Malden, you got Malden Economics, you've got Stan Druckenmiller, used to manage George Soros's money, saying, he'd rather be short than long right now. Jeff Gundlach manages billions of dollars. He's more of a bond guy, but he's saying, hey, it justifies bonds right now. That's at least a safer way to protect your money in the market than buy these overvalued stocks. The guy that called the big short in 2008 is saying, this is the worst bubble than we've been in back then, and I knew it was going to fall. So all the people that actually know stuff are saying, be careful. I'm saying be careful. Let's be careful. Guess what? While we're being careful, we can make money in the market, in the bond market or the short-term bond market. I mean, I'm okay making 5% while we're waiting for this all to shake out. I'm okay making, high interest earnings in your money markets or even a bank CD making 5 or 6%. That's a no-lose proposition, whereas the market could be a big lose proposition. Meanwhile, we wait for our opportunity to buy, we don't lose money, and we jump back in. The index products that I've talked about over and over again, the indexed annuities, even LERPs, if we get a surprise year like last year, even though it's manipulated, and we can make 10 or 15 or 10 or 12% in an index on the upside and something that's just as safe as a CD that can't go down if we're wrong, we still get the upside on those safe money products that we've had as long as they're market-based and have decent caps, and that's kind of hard to find now, and that's a whole nother story we can go into in another segment. But bottom line is the index products that we use are principal guaranteed, and they still go up when the market's good. They don't lose money. We can still make money in those while we're waiting for the market to give us a better buying opportunity for our liquid money that's based in market, and that's based on how much risk we can take. If you're young, who cares? But if you're listening to this radio show and you're ready to retire or already retired, you want to protect the millions you worked a lifetime to save, or even if it's hundreds of thousands of dollars, whatever it is, if you work a lifetime to secure that asset base so that you can live through your retirement, why would you risk it in an overvalued market? Or why would you be buying in? In fact, if you've made a ton of money in the last decade or made a ton of money even in the last year, why not take some of that profit off the table and be smart with it and put it in a safe place where it can't go down when the market crashes? And guess what? Market goes down, we buy back in. You can still withdraw money from those other accounts, dollar cost average back in the market when it gives us a better buying opportunity, and continue to grow your money even in retirement, but do it responsibly. So again, back to people thinking there's a crash. I'm not the only one.
That's Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, if you'd like to sit down with Jeff and talk about your individual situation and how all this applies to you, that number to call, 520-780-9059 for your complimentary Premier Retirement Review. 520-780-9059. You're online at premret.com. Time for a break. Jeff will be right back with more of Premier Retirement and listener questions when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We're so glad you decided to join us this weekend for Premier Retirement with Jeff Hogan. We're here for you each and every week for your fiscal fitness, your financial education. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also on Sundays at 11 a.m. And if you can't join us those times, remember we're a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Jeff, in this segment, as always, we answer listener questions. We got 3 of them this week. We'll kick it off with Don listening to us in Tucson. And Don writes, I have an inherited IRA from a 90-year-old sister who had begun distribution before her death. I don't need or want her distributions yet. Is there a more practical way I can currently avoid the distribution taxes on these funds without adding her distribution to mine until later? I'm 86 years old and currently taking my own RMDs.
Well, apparently she took those distributions a long time ago, so this was pre-2000. There are some different rules that apply on the post-2000, after they started changing the CARES Act and the Secure Act and all the IRA rules. Even retroactively, the government is going to make you deplete that asset over the next 10 years. The current distributions, because they were already intact. Now, they've changed the ruling on this, and I'm not going to be a CPA or tell you this, but the last I've read is it seems like the IRS is going to enforce both ends of those rules. If your sister already, even though she died pre-2000, you have to continue to take those distributions because the IRS expected to get those funds. The other thing is it will not deplete in 10 years. So if you have to deplete it within the next 10 years due to the new rules, then you have to kind of figure out how that's going to hit you tax-wise. You're 86, you hate your own required distributions because they're causing you a tax problem probably, and then you've got, a sister with additional tax money that's going to hit you. You can either try to take as little as you can out. Maybe you die before it's all passed on, and then your heirs get to pay the taxes at their rates, but that might be even worse than yours. Do you want to just take one big swing and take a big tax hit while at least the taxes are at a bracket that you may be more comfortable? If you're in the top tax bracket is lower right now than it's going to be in 2 years. So if adding those distributions, whether they're now, whether they're lump sum, whether they're later, whether they're sometime in the future, or even to your heirs, consider the tax bracket at the time that those distributions are going to be taken out before you make that final decision. But again, I believe in paying less taxes over the long haul. But, if you're in a 12% tax bracket, which is going to be the 15% tax bracket in 2026, it's a bummer that you have these extra tax liabilities. Maybe you want to kick that can down the road as much as you can to take any bigger final distributions down the road rather than, compound your already just right at the limit of going from 12 to 22 or the 15 to 25, which is going to be in a couple of years. If you're going to jump a big tax bracket because of this, it might be smart to just do as much damage as you can early on or just pencil it out over the next 10 years. Now, find out from your CPA and find out from your tax person. Now, I do tax planning, but again, these rules are they've been keep moving the goalpost on these IRAs and the distributions on, what applies to the new ones, what applies to the old ones, what applies to a non-spouse inherited IRA. You've got different rules than if it was a spousal IRA. Spousal IRA, you can just make it your own and take distributions forever. There's no 10-year rule until you die and your kids get it. So on a sister, that's a non-spouse IRA, inherited IRA, and you've got different rules. So if I knew your total situation, what tax bracket you were in, what other monies were causing you a tax problem, maybe you've got a bunch of mutual funds that keep on giving you a 1099 every year, and in good years you go into a higher tax bracket, and bad years you go into a lower tax bracket. If that's the case, you don't really have a good tax plan. You're just kind of at the whim of whatever the tax bracket ends up being at the end of the year. So maybe a more comprehensive tax plan is needed before it is needed before I can give you the right answer or the best answer for you. I do know that you will have additional income on this annuity, even though you're taking your own RMDs. You can't count your own RMDs or your own distributions for your sisters. Now, here's the thought. If you have charitable intent, or if you love your church or love a charity, or your kids or grandkids go to a school that could use extra help, you can always give those distributions directly to a charity. They never come into your tax return as income. They go direct to the charity, and they do qualify as a distribution to a charity, and it's a tax offset. So you don't get the tax write-off. You just don't have to include it as income. So you don't have to include it as income, use up or have it buried in your standard deduction and not be able to write off a charitable contribution. This way you can actually write off the charitable contribution by not having it included in your income in the first place. And if that's the case, and you don't itemize your deductions, depending on what your situation is, If you're married or single, your tax bracket and your deductions are going to be the same, or are going to be different. But given that might be another way to look at it by doing some sort of a tax plan. You could even convert that entire IRA into a donor advised fund, depending on how big the IRA is and depending on your income. You could do a donor advised fund where you give a whole bunch of money away, direct a deposit straight into a charitable account, and then you get to dole it out to the charities, for the rest of your life as you see fit. So there's a few ways to skin that cat. I mean, if you don't need the money, you don't want the tax problem, then maybe charitable giving is the best route. If not, let's just figure out what the best tax consequence will be, keeping you in the lowest bracket for the longest period of time.
Don, thanks a lot for sending us that question. Of course, we don't have all the details there, so I would encourage you to give Jeff a call. Get in and sit down and get the answers to your question. Jeff's number, 520-780-9059. In the meantime, we'll send you out Jeff's book, Retirement: The Road Ahead. Okay, Jeff, next question is Steve, listening to us in Oro Valley. Steve says, I've just learned that I'll be losing my $90,000 a year IT job late next month. I'm currently contributing to the company's 401k plan. My wife and I are debt-free except for our house. We're also cash flowing one daughter's wedding in June and cash flowing another daughter through college. So along with a sizable severance package, we're in reasonable shape, all things considered. I wonder, though, if I should stop contributing to my 401k and start stockpiling cash until another employment opportunity comes along. Your opinion?
Okay, so let's just say you're mid-50s, 55. Now, there's a couple of things that are applicable if you're 55. If you quit or lose your job and you have a 401k, you can actually take money out of that and live on if you need to without paying a tax penalty. You do have to pay tax on that as income. However, now when you said you're going to continue contributing to the 401k and stockpile cash without a job next month, you can't contribute to the 401k. So that's kind of out. I would say, yeah, do your next month contribution for your $2,000 or whatever you're putting away. I'd put it away in the 401k and let them match you and know that you can get it out without a penalty. The other thing you can do is you can borrow from a 401k without a tax ramification. That might be okay, but if you're losing your job this early in the year, I'm thinking you're not going to have a really big tax year. So it might be fine to use your 401k money to live on if that is your bridge, if you don't have that extra cash sitting around in the bank or in a brokerage account outside of that. I don't know what the total amount is in that account. I do know that you've got a lot of expenses coming up if you're putting kids through college and marrying off kids. So those things are not cheap. $90,000 a year, if that's your only income, you're debt free. That's good. But I don't know what you can live on. And I don't know how much you have in savings or, how much is even in your 401k plan. So there's not really a relevant scenario here that I can speak to. But again, you might want to consider using that 401k money until you get a new job. And by the way, welcome to the club. There is a lot of people that have been coming into my office recently that have lost IT or computer or high-tech jobs. Yet we're seeing the NASDAQ and the tech market go berserk. Yet Facebook's laying off tens of thousands of people. All kinds of these tech companies, banks, UPS, Spotify did, Citicorp just recently have announced layoffs of tens of thousands of people. So you're in a big club of people that are losing their jobs and losing high-paying jobs. Yet the government keeps on telling us how awesome they are by creating 300,000 new jobs in a month, all of which pay about minimum wage in their government jobs. If you want to go work for the government and shovel dirt on a road or do something, I don't know whatever those jobs pay, but $90,000 a year is one of those jobs where, it's going to be hard to find. It might take you a few months to get back on there. Honestly, it just proves what I've been saying. I'm not trying to make light or use your unfortunate example, Steve, as a way to bash the current administration. But honestly, Bidenomics does not work. If there's all these jobs created, inflation is still going up and unemployment is down below historic levels. And if we're really making some sort of a manufacturing renaissance and the economy is growing, it isn't. You're losing your job. I mean, you're smart enough to call this radio show. I'm sorry you're smart enough to have a good job. I mean, tongue in cheek here, but you're in the IT business. I mean, you're qualified for a ton of jobs and you may have a big problem getting. I have, several clients that are having trouble that have been making six figures, maybe multiple six-figure incomes, can't even come close to a six-figure job anymore. And they've been looking, some of them a year and a half to 2 years. It doesn't seem like it's really getting better. So I don't know where these new jobs are going. I don't know where this economy that Bidenomics says they're fixing and turned around America, and America's already great again, so it doesn't need to be made any greater because Bidenomics is working. It isn't working, and you're proof of that. I wish I knew more of the numbers. I can maybe give you a little plan. If you want to come in and talk about a plan to make that money last as long as you can without, risking it in the stock market or risking as much as you can afford to lose. If you're in your 40s, you've got a longer time horizon and you don't have access to your 401k. If you're older, maybe you can move to a self-directed IRA and use it. If you're over 59 and a half, you can use it there. So there's a lot of different options that I don't have from this question that you might want to look at. And I'm happy to explore them with you if you'd like to come in.
And it sounds like Steve does have some cash there. If he's cash flowing his daughter's wedding, we know that that's not inexpensive. You've got a couple of daughters, and he's also cash flowing another through college. So, Steve, we would suggest that you give Jeff a call, 520-780-9059, and get your questions answered. We'll also send you out Jeff's book, Retirement: The Road Ahead. Okay, Jeff, final question this week. Cheryl from Rancho Vistoso. Cheryl says, I just found your show about a month ago, and I start every Saturday morning with it. Thank you so much, Cheryl. I want to start investing in stocks on my own, and I've heard you talk about small cap, mid cap, and large cap stocks, and I was wondering what they are and when you would use one over the other.
Well, they're kind of like what they say. Small cap is like the, little billion-dollar companies, which sounds big to you and me, but they're still, publicly listed company. Mid caps are bigger, like the tens of billions or even 100 billion. And then the large caps are like the Apples, the Metas, the companies that can approach $1 trillion in market value. The companies you've heard of, Johnson & Johnson, Merck, Eli Lilly, Pfizer, Coca-Cola. Those are all big cap and a lot of people say, oh, well, the blue chips, they also call them blue chips, large cap stocks, blue chips, they're big. These are companies that would have a really hard time going bankrupt or going out of business. So a lot of times people like those kind of stocks because they seem a little bit more solid. The mid caps are still kind of growing they're kind of like teenagers, like they're just growing into that big cap phase where, maybe there's a little bit more risk, but they have a little bit more upside because, a little bit more nimble. They don't have a lot of overhead. Maybe they don't have offices on every corner or stores on every corner. They've got to keep overhead and, zillions of employees yet, but they're trying to grow from a small cap, which is more of a startup. Hey, we finally got big enough to go public. We're big enough. A billion-dollar company can go out of business just with a bad year or two and just a bad business decision. Economic situations can cause it problems. But the small and the mid-cap business is really the heartbeat of America. It really is. And if you look at the Russell 2000 or even the Wilshire 5000, those are indexes that have a more broad base of all the different size stocks in them. If you look in the Russell 2000 is kind of given credit for adding a lot more of the small and mid caps in it. That's why the S&P 500 is typically large caps and they're big. I mean, they're big, solid companies. They're blue chip companies. So the S&P 500 is 500 really big stocks. And they include things like Facebook and Google, Amazon, NVIDIA, Microsoft, Apple. All those companies are companies that basically supply some sort of a good or service that the world just cannot do without. And because they're such huge companies, they get a lot of buying power. And really with just 7 or 8 of those stocks, you can actually drive the entire index of 500 stocks. You can actually make the index look like it's doing a lot better than it really is. For example, last year, the big cap stocks, the large cap stocks make up the S&P 500. 7 of those stocks contributed to almost 100% of the earnings. The other 493 stocks were just a little bit better than break even. Of those stocks, 2/3 of them, might have gone up a little bit, but 1/3 or almost a half of those other 493 stocks actually went down. There's not a lot of market breadth, meaning that the entire market isn't that good. Well, is it just the small companies that are going down? No, these are large cap stocks. They can go down too, but large cap stocks are huge. Sometimes the banks, the big market makers love those because they're the ones that make the news. If you want to just buy all the small and mid cap stocks with a little bit of big cap in there, you would do like the IWM. It's a lot more mid. Now, there's also one called IWC. It's iShares, but that's basically an ETF that you can look at. IWC are the ticker symbols, and that is basically all the micro or small cap stocks. These are ones even under $1 billion. And that might also give you an indication of where the market might go. Now, interestingly, the large cap stocks have on average a PE ratio, price earnings ratio, somewhere between 25 and $30. People are willing to pay $25 or $30 for $1 of earnings on those companies. On the micro caps right now, the index is about 10, which means the micro cap and the mid cap might be considered undervalued because they've kind of been forgotten in all this hoopla and the AI craze and the overbuying the Amazons and Apples and Netflix and Facebooks and Microsoft. So there is a time when the small and mid cap stocks are going to start, coming back up. But if you look at the last 2 years, they've consistently still been trending down. Every time they try to make a new high, the high goes down and reverses. Now, just at the end of the year, the higher high after about 5 of these different downtrending cycles it finally broke out. In other words, it finally looked like the mid caps and the small caps, and this might have been what you heard me talking about in the recent past, is just started to kind of break out and go above what we thought was their support or their resistance level. It looked like the small and mid caps were finally going to make a rebound, and the big cap, the large cap stocks were finally going to run out of gas because they've been really overbought and people have been paying so much more for them that just made a lot more sense to buy these smaller and mid cap stocks. And honestly, I think if I were to invest for the long haul right now, if I were to be jumping into the stock market, and I'm not, I'm still kind of waiting for a better opportunity. I think even the micro caps and the small caps, the Russell 2000s, are still going to get hit if the stock market has a major or even a moderate sell-off. Now, the Russell 2000, which again includes some of the bigger stocks and bigger names, not micro cap, has been kind of running even for the last couple of years. It crashed a little bit, it bounced back for a minute, then it crashed. It's had, again, about 5 different market cycles, and those cycles are about even. It's actually, in the last 2 years, the Russell 2000 is still down lower than what it was. The big indexes of the big large cap stocks have actually grown to higher levels. So again, the price earnings ratio of the Russell 2000 is 12. That's a lot more reasonable number. So if you're looking for value, and again, I'm going back to fundamentals. Fundamentals means what is somebody with a sound mind willing to pay for earnings of a company, not just a name that is hyped on the news. Well, I think the small caps and the mid caps make a lot of sense right now. IWM and IWC are a way to buy into those. And I'm not making a recommendation here because I don't know your situation. But if I'm looking at the long haul, I just don't see them getting beat up as bad as I see something that's valued at the 30 price earnings ratio, an index that is so overbought and overvalued and higher than statistically normal prices, that if it corrects and goes down half, I don't see the micro caps and the smaller companies and the mid caps going down as much. And I do see that if there is kind of an outflow from these overpriced bigger stocks, I think smart money that still wants to be in stocks will start going that route. And there will come a time when I'm a little bit more hip on them. And honestly, at the first of the year, we started rotating back into them for a minute. And then, the market broke down and the interest rates, Powell said, hey, just joking. We're not really going to lower interest rates. Ha ha. Joke's on you. And by the way, the banks aren't going to really do it 7 times and inflation isn't really in check. And you might see that on the next CPI numbers. But I'm not going to tell you that yet. We'll wait till the 3rd week of February to let you know. I think that's a good question about what the difference is. Small cap and mid cap, I think, are fairly or undervalued right now, considering their long-term history and valuations over time. There's a big divergence between the growth in the big caps and the growth in the small and mid caps. So I hope that answered your question. If it's just kind of if you're talking about where should I invest, I'm a little scared to invest in those large caps that are overvalued, especially those ones that have been overly hyped. Those Magnificent Seven, I think, are going to be the ones that hit the wall first if they do. Again, I don't have a crystal ball. I don't know if they will or won't, but I do know that I'm scared to overpay for a lot of things. I like to buy things that are fairly valued. I like deals, and I don't think there's a lot of deals in the big caps. I think the deals are better in the small and mids.
Cheryl, thanks a lot for that question. Of course, we'll be sending you out Jeff's book, Retirement: The Road Ahead. If you've got a question for us you'd like us to answer on the air, get it to us by going to premret.com. There's a contact form there, and sending it to us from there. You can also give Shelley a call if you'd like, 520-780-9059, if you want to dictate the question to her. Nevertheless, however you send it, if we do use it on the air, we'll be sending you out Jeff's book, Retirement: The Road Ahead. And in the meantime, listening to the program today, if you'd like to sit down with Jeff, talk about your individual journey towards a prosperous retirement, a confident retirement that could last as long as 30 years. You've got questions. Jeff has the answers for you. No cost, no obligation for this retirement review. To get yours, call 520-780-9059. 520-780-9059. No cost, no obligation for this. Just a friendly conversation to put you on the right path and get your questions answered. Again, 520-780-9059. You can also request it online at premret.com. That's premret.com. Jeff, not a lot of time left in the program today, but, people listening to the program are probably here because they want to grow their wealth or they want to retire. Let's talk about somebody who wants to retire in 2025. That could be a year, could be a year and a half, almost 2 years from now. What should somebody be looking at right off the bat to determine whether or not it's feasible for them to retire in 1 year?
Yeah, I'll just tell you about somebody that came in last night, my last appointment of the week before the show here, and wanted to retire in a year. Very similar situation. Had about $1 million in assets, a pretty good job, making about $120 a year. Thought they wanted to go part-time, but the part-time income just doesn't cut it. And she said to me, she says, I just don't want to do this anymore. What do we do? Being a single woman, she's in a pretty high tax bracket. She's been in the 22 or the 22-ish bracket. not quite the 24, but what's going to be the 25% tax bracket coming up soon. She doesn't want to go into the 28% tax bracket, which, for a single woman is going to start somewhere around $100,000 taxable. So she wants to be below that. We can keep her below that. So what we did is we structured her IRAs. We're going to do some Roth conversions during the year now that she's working part-time and has lower income to add to her already Roth so she can get tax-free income. What it comes down to is she's going to be able to live on a total income of about $100,000 a year. Her taxes are going to be about 10 to 12. But the cool thing is we're converting some to LERPs and Roths. She's still healthy enough to get LERP life insurance retirement plans and Roths and create tax-free income of about $30,000 a year. If she's living on 100 minus her deduction plus $30,000 a year in tax-free income, she's only paying taxes on not quite $60,000 a year, which is, I think pretty strong. So, if you can live on $60,000 taxable, yet live on 100, only pay $10,000 in taxes, we're living on $85,000 or $90,000 a year, which is similar to what she was living on when she was making $120,000. Then she kind of scaled back and was making $90,000 last year. Now she wants to just cruise this year and make about half that. But how do we do it? We just reposition those assets to create guaranteed or predictable income. We create enough tax-free income and enough taxable income that we know is going to have to be coming out of her 401k because it's going to be taxable anyway. But instead of waiting till she's 73 and taking required minimum distributions at a small amount and having it go up every year and have her eventually be in a high tax bracket, we're actually front-end loading those withdrawals to keep her in a pretty similar straight line, basically a straight line tax situation where we know what her taxable income is going to be for the rest of her life. Tax-free income, taxable income. We have guaranteed income sources that add up to about $95,000 a year, and she's still's got about $250,000 in liquid money she can play around with. She can invest in either bonds, invest in the market if she has a risk tolerance for that, or just buy some CDs and keep it as a rainy day money should she need it. So she's going to have more money spendable than she actually was spending after she was putting money away in her 401k and paying taxes, Social Security, and all those other things when she was working. So she had done well. She lived within her means. She'd saved a reasonable amount of money, and when it came in, we found out that she could, in fact, retire 4 years earlier than she had originally planned.
So whether you're planning on retiring this year, next year, or maybe a few years in the future, get in and sit down with Jeff and talk about your retirement journey. Of course, Jeff will have the answers for you to help make sure that your retirement journey is what you'd like it to be. And keep in mind that, your retirement could last 30 plus years or more. You need to plan for that. So for your no cost, no obligation, and no judgment retirement review, once again, 520-780-9059. You can also request it online at premret.com, PREMRET.com. Jeff, out of time for this week. I want to thank you for your time, but most of all, I want to thank our listeners for joining us. For Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.